So let me share with you how does true wealth is built in companies who have both high profitability and high return on capital. To understand that, we have to understand a phenomena called PE ratio. Now, PE ratio is nothing but just a mathematical formula where we take the market price of the company and divide it by how much companies is earning, and we make it per share basis. So for example, if the market price per share is 100 rupees and the company is earning per share 5 rupees, so the PE ratio will be 100 by 5 is equal to 20. Now in reality, people apply shortcuts to find what should be the projected future market price of the company. What they do is they take the current PE ratio, that was let's say 20 times, and multiply it with projected EPS to find the future market price. And this is where there's a hidden hack for building wealth. See, understand, if the company is having high return on capital and a high EPS, and it is investing its money back into its business, and it is earning the same return on capital on that additional capital which is reinvested, the stock market as a whole will give this company a much higher PE ratio as compared to a company which is having the same EPS but a lower ROC. Now, why is that? The reason for that is because it is incredibly valuable to find companies that are earning high return on capital year on year basis and still growing. What I mean by that is, let's take an example of two companies, company A, company B. Company A is growing at 10%, company B is also growing at 10%. Both are growing at 10%. Now company A and B both are reinvesting whatever profits they are earning back into the business. Company A's return on capital right now is 25%, and company's B's return on capital is quite low as compared to 10%. And they have the same profitability when it comes to their sales, and the future projected EPS is let's say 20 rupees. Now what should be the PE ratio and what should be the market price per share? What will happen is, take a very simple example. In the case of company A, we said two things. First of all, the company has a higher ROC, which it has, return on capital, and whatever additional capital the company is reinvesting, it will earn the same ROC on that additional capital. So let's assume that company A, first year, it has 100 rupees return, it has its capital is 100 rupees in case of company A, and it's 100 rupees, its profit is 25. Now, the profit is 25 rupees on this 100 rupees capital. Now what will company do next year? Will reinvest this money back into the capital. What will happen now? The opening capital next year will become 100 plus 25, right? So the opening capital will become 125. Now the return on capital, which is 25%, let's assume that it becomes 25% again on return on capital. So what do you think its profitability is now? Let's assume in this case, the revenue was 100 and it has grown to 110. But the company is able to generate a return on capital of 25% on its additional capital also, that is 25. So company is earning a profit of 31.25. What is the profitability ratio now of this company, company A? The profitability ratio will be 31.25 divided by 110, right? That is 28.40% in the next year. What do you think is going to happen to the company B? Will it increase that much? Absolutely not. Why? Because the return on capital is much lower than company A. So what happens is, if your company has a high return on capital and it is maintaining that return on capital year after year on its additional invested capital, then its profitability grows not arithmetically, but exponentially. And that is why stock market as a whole pays much higher PE ratio to these kind of companies which are growing and they are able to maintain their high return on capital. Now if the market pays much higher PE ratio and the companies are earning continuous EPS, what will happen to the market price? It will create a loop of what? The EPS will rise, the company is earning the same return on capital. So the PE ratio will keep on rising much higher than their competitors on year basis. And this will return in a much higher value of the price of these companies. So what happens? Now what happens when a profitable company earning high return on its capital, invests in its business, and earns the same or higher return on capital on its additional capital, which is a very difficult thing to do. The profit will grow exponentially. And when EPS grow exponentially, the stock market gives it a much higher PE ratio, giving you, the investors, a very high return on an investment through increased market prices. This is how actually the investing in stocks generate massive wealth for investors. This is how the real wealth building in stock investing works. In profitability, we were focused on a very limited area. We were just focused how much profit was being made on each dollar of sale. In return on capital, we expand our thinking. We are now focused on how much company is making on each dollar of capital invested. And this is a much better metric to understand how well the company is performing.